The push to automate financial services started with physical hardware. In 1967, Barclays Bank unveiled the world's first automated teller machine. By 1983, the Nottingham Building Society launched HomeLink, allowing customers to use connected terminals to view statements and transfer money from their living rooms. A decade later, personal computers brought this data directly to the desktop. In 1994, Microsoft Money became the first personal finance software product to implement electronic account transfers. That same era introduced the hardware that would eventually host modern mobile banking, beginning with the IBM Simon Personal Communicator in 1992. But these historical milestones were largely about access. Early digitization simply took the traditional centralized banking ledger and put it on a digital screen. Today, that centralized ledger has been fractured. The modern financial technology landscape is a highly fragmented ecosystem of specialized software companies. Historically, a bank performed a specific set of functions. It matched capital from depositors to borrowers, and it managed the operational risk of making those transactions happen. How do dozens of independent, non-bank software entities safely execute these highly regulated functions? They do it by stripping the institution down to its studs. Fintech is structurally unbundling the traditional bank into specialized layers of software, changing exactly how capital is managed and allocated. For centuries, the back office of a legacy bank relied on human labor. Processing forms, verifying files, and extracting data required an army of clerks. The first layer of the modern fintech stack digitizes those operations. Robotic Process Automation, or RPA, deploys software robotics to execute high-volume, repetitive office tasks. Instead of waiting on human input, RPA systems instantly extract data, fill in forms, and route files. They eliminate the bottleneck of human error. We see this applied directly during the automated customer onboarding process. Opening an account used to require a physical ID check at a branch. Now, that requirement is fulfilled by biometric authentication. Fingerprint verification and facial recognition provide secure, immediate methods for digital verification. That verified identity data flows directly into the RPA-managed database, opening the account and making it ready for immediate use. By automating the back office, software platforms lower the marginal cost of servicing a customer. They can scale at a rate physical banks cannot match. With operations automated, the fintech stack moves to its second layer, digitizing decision-making. When applying for a loan, legacy banks assess risk through a strict reliance on historical credit scores and past tax returns. Because early-stage businesses lack this extensive history, they are often locked out of the system. In 2019, traditional banks rejected nearly 80% of small business loans. The software solution to this funding gap is data mining. Modern financial interactions generate immense unstructured databases. There is too much information for human analysts to effectively process. Artificial intelligence steps in to filter this chaotic data. It extracts valuable patterns to build highly accurate risk profiles. Instead of just past history, AI relies on real-time analysis of alternative data points to create a comprehensive risk assessment. This intelligence layer also extends directly to the customer. Chatbot interfaces like CIMB's EVA for small and medium enterprises act as automated frontline staff to handle routine queries and process initial business requests instantly. By transforming unreadable digital footprints into safe, actionable risk assessments, AI and data mining bypass the human loan officer, extending credit to startups that traditional models exclude. The third layer of the stack takes this intelligence and applies it to capital formation. The traditional banking model operates as a central, opaque vault. It pools deposits from customers and lends that money out at a profit. Peer-to-peer or P2P financing bypasses the vault entirely. This illustrates the core mechanism of P2P lending. Online platforms aggregate capital directly from individual investors, funneling it straight to a borrower. Acting as the digital intermediary, the platform utilizes AI risk profiling, calculating exact interest rates based on the borrower's specific risk profile. This model comes with a distinct trade-off. It generally promises higher returns for individual investors, but those investors take on higher, localized risk. P2P platforms decentralize the bank's core matching function. They democratize who can act as a lender and who can receive capital. When combined, this unbundled stack powers much broader commercial ecosystems. The technical reality of an online marketplace is far more complex than a direct exchange between buyer and seller. A sale requires juggling multiple currencies, determining operator commissions, and adhering to local tax rules. Integrated Fintech automates this process. It instantaneously splits and disperses a single payment to vendors, the platform, and tax authorities. There is simply too much money changing hands for the books to be kept by human accountants. Without this underlying software infrastructure, the modern digital marketplace could not function. The integration of automated processes, artificial intelligence, and decentralized platforms has established a formal digital economy. To see how this structural unbundling is playing out, we have to look at how sovereign nations are responding to it. Malaysia's financial sector provides a clear case study of state-sponsored digital disruption. This document from Bank Negara Malaysia shows central regulators formally embracing the unbundling by issuing official digital bank licenses to non-bank entities. The successful applicants are not legacy banks. They are consortiums formed by e-commerce companies and tech platforms like C Limited and Boost Holdings. Formalizing this sector drives massive capital formation. Regulated crowdfunding markets in Malaysia have already raised over 1 billion ringgit for micro, small, and medium enterprises. Financial technology has transitioned from experimental interference into a regulated, structural component of the banking system. The success of these digital-first consortiums marks a shift in financial architecture. By unbundling the bank into specialized software layers, these systems are optimizing efficiency and broadening access to capital.